Watters. We have a great night ahead of us and looking forward to spending the next hour with everyone who's joined us. For those of you who are joining one of our webinars for the first time tonight, let me talk to you a little bit about the format. We bring in some of the industry's most trusted experts, and we just spend an hour learning from them. So tonight we're blessed to have Charles to join us, and he'll have lots of insight to share with us. What we've done this year is the primary focus of our webinars have been to take the content that we used early in the year at the Nexus meeting. So every year, OrthoFi does a business meeting for the industry, and we bring some of the some key speakers in the industry together to really learn from them. And this year, the content was just so great that we thought it would be a waste not to turn those sessions into webinars that the whole industry could learn from rather than just the people that were at the meeting with us in February. We have now announced the location and the dates for next year's meeting. So at the end of this webinar, I'll share that with you, and also a special for joining us, so you can get a discount if you go ahead and register for that. So make sure you stay tuned to the end of the meeting to learn a little bit more about our Nexus 2024 meeting. Throughout this webinar, you will be able to submit questions, and I want to ask that you use the Q&A link rather than the chat. We have a team monitoring those questions, and we'll kind of keep up with them throughout Charles's webinar, and then we'll spend the last 10 minutes running through some of those questions. So be sure to put your questions in the chat anytime you want to as Charles is speaking, and it maybe makes you think of something that you want to ask. So we'll get right to it. I want to say that Charles joined Cain Watters Associates in 2001. He became a partner in 2016, and now he plays a critical role in growing the firm's client base as the Director of Business Development, Marketing, and New Client Services. Charles also travels the country speaking, and cool fact, he's presented to over 30,000 dentists and over 50 dental schools since 2004. That's pretty amazing. He's also a published author, and he's a host of the top-ranking dental podcast, Transition Talk. Kind of what brings Charles to us tonight, however, is that he oversees the practice transition department of Cain Watters, and he's the founder of its affiliate company, the National Dental Placements. And this company assists doctors in buying, transitioning, and evaluating practices. So he and his teams have helped hundreds of dental professionals with their transition goals annually. And his passion is helping to diagnose the financial support dentists need, and then connecting them with someone who can help them to achieve their goals. So I know that this background and everything that Charles helps with on a day in, day out basis, or it's going to give him just the information that we need to share with the industry today. Charles, welcome, and thank you for joining us.
Thank you, Marla. That's a good little video there on OrthoFi as well to kind of start this thing. That was you guys are doing really well. I was checking in with all of our orthodontic advisors and just like, hey, I'm doing this OrthoFi thing, making sure that they're still doing a good job, and it was all thumbs up across the board. So yeah, main thing I was just kind of checking in with them on is just the product and everything has continued to be outstanding. And yeah, it was just I got about eight advisors all in the ortho, and they're loving the product, so keep doing a good job there.
Great, that's so great to hear. Appreciate the word there, Charles, and we're all looking forward to hearing from you. And I'm just gonna go away for a little bit and let you share. Thank you.
All right, you got it. Well, good evening. For those of you who have not, seen me speak before, as Marla said, I have had a chance to speak all around the country to literally just dental schools and state national meetings, to symposiums, AAO type meetings, and so. The idea is to try to give you as much as we can in a very short amount of time. So we don't have much time here, so we're going to try to keep the lecture to what you really want to hear, which is the value of your dental, the value of your dental practice. Let me see here. Let me do one more thing. Click into here. Okay, animation going here. Couldn't get that. Let me just see one more thing. It looks so good in our little warm up here. We try it one more time. Okay. Well, I apologize about that. Give me one more second.
No worries, Charles. We're good.
Sorry.
All good. I'm sure everybody's getting their Coke or their wine to get settled in anyway.
Yeah.
I think earlier you just clicked that from beginning there and it.
Yeah. But it's not allowing me to hit that.
Oh,
It's my what it is my black screen on the top. I can't move that bar. Here we go. Oh my goodness, that's so much easier. Okay, all good. Sorry
okay.
about that.
All good.
All right, get going. I promise you, I've done this before. Okay. This was the game that you had to play with during all of our COVID presentations. So it's been a while since I've used the Zoom again. So back at it. All right. So I'm not going to give you a commercial, but certainly give you a little bit of backdrop on the company, just because I think it's always important to hear just about the company and the speaker, just so you can see their knowledge base. So I've been doing this for over 23 years. The firm's been in place. I'll be 40 years this next coming year. We have over 300 employees. It's basically a CPA firm that just focuses in the space of dentistry. But what's unique about it is we have over 700 orthodontists. The whole role that we love to kind of play here is kind of like a CFO. So I'm looking at, how to really improve someone's financial life. And when you think about their financial life, it's their personal financial plan, but it's also what to do with their dental practice. And she's quickly what to do with their orthodontic practice. So creating a financial peace and security is honestly what we're trying to do. Service lines, financial planning. We manage over $3 billion of assets, over 90 CPAs that work at the firm. So very technical on the tax side of things, accounting, bookkeeping services, as well as just kind of valuations and transition strategies. We value and assist people to in their transition of their practice over 100 times a year. So we're going to learn and what we teach tonight. I'm going to really push through about the next probably 15 slides. And what I want to do in the next maybe 10 minutes is just so you understand there's a value of your practice, and it's an asset, and it's a huge asset, but you have other assets as well. And so I want to cover what those assets are, and then it kind of ties back into this asset, the dental practice. What we believe is that, owning this practice, it's important to grow it. We do not like stability. We want the efficiencies and growing the top line because it makes our practices more efficient when you understand fixed costs, fixed and direct costs. So we like to grow our businesses, and that means expansion, that means associates, that means acquisitions, because they become more profitable, allows more control, allows the flexibility to bring other people in. It also grows your net worth as you become taking your business, to another level, making it more successful. At that point, when you can't physically do any more dentistry, the business of dentistry is a very taxing, very demanding thing. So if that's the case, at some point you can't do any more starts. So at what point do you bring an associate in? We definitely want to educate and kind of push you to that level. Typically, you'll see orthodontists before they're bringing in associates, they're at least doing, $2 million. When you make a lot of money, taxes are a huge part of the problem. So you certainly want to combat taxes with owning the business. as well as just making sure you've got the right pension plans in place. You want to understand with good accounting, good break-even systems so you can make good decisions with the associate or new buildings. You want to understand the value of just your orthodontic practice, which will be the focus tonight. Got some case studies of kind of a $1 million, $2 million, $3 million type practice. Does it make sense to, is this a private equity value? What's a real valuation on this? And even giving you kind of a test to make sure that you're paying attention and you're learning, and even how to calculate your EBITDA and what's expected in today's market on the private equity side of things. So three things I want you to really focus on is, number one, knowing your business, understanding really good financial statements. Financial statements, for an orthodontic practice, we're looking at key indicators. And so my key indicators are going to be my team costs, my lab costs, and my supply costs. So I really want good financial statements that have those outlined. And I'll give you an example of a profit loss statement that I don't like. And I'll give you my indicators with actual percentages, tied to that. And when you have key indicators, what it allows you to do is have a strategy, and a strategy about the growth of it, and the strategy is just about, having the practice more profitable. When you look at the same type of in-depth focus that we've just now looked at in our business, we want to look at that as our home. So we typically want to focus on making sure we understand what your lifestyle is. In other words, going back and having your financial planner look at exactly what your lifestyle is, making sure you have good savings goals to meet those retirements, and including having proactive planning with your taxes. Last piece is understand the asset of the dental practice, in this case, the orthodontic practice. And these are huge values, especially when you can take in consideration what the private equity game has basically come into our space, and for the last 10 years really pushed valuations at very high levels of where they're at today. So I want to talk about just what the value is of your business and kind of some options, either bringing associates in or just doing the walk away on a smaller practice, or some type of OSO, DSO type private equity, sell, and what that would look like. This slide is meant to remind you that when you sell your business, if you sell your business of 100% to the associate, and they basically oversee the business now, or you sell to a private equity group, it's super important that that you're going to give up 5 great benefits of ownership. And number one is you're always going to be making more money as the owner. Number one. Number two, tax planning is massive. And so, you don't get any tax planning when you sell your business. So it's important that you understand that you're giving that up when you sell the business. The pension plan is important. You keep your pension plan throughout your entire career. And typically we're seeing 45, 50, 55-year-olds with, cash balance plans where they're saving maybe a couple $100,000 a year, therefore growing their wealth, therefore getting huge tax deductions. All of that just comes to a stop. The equity of your business as well is something that's worth, millions of dollars. So it's important to see what that is, what is worth. And lastly, the reason you're owning a business is because you're just simply in charge. It's important to have a financial plan because this is a big part of it. When you're going to sell this business, it will impact your financial plan. So just making sure you're meeting with your advisors and you have just a very strategic plan about where you're going to go. We typically would see a 30-year-old that's going to need $8, $10, $12 million to retire on. We may see a 40-year-old that's going to need, $6, $7, $8, $9 million to retire on. So having the business, in this case, an orthodontic practice, it's worth something. How can it impact your financial plan? Either A, just selling, to a private practice, owner, and maybe it's $1 million practice and you sell it for $1 million. Well, that's something you can count on in this space because you're in a seller's market right now where, there's basically much more, from a buyer's perspective looking for. So that's great when you're an owner because it allows your practice value to be high. And so we want to talk about what the valuations are today for the private practice owner. And certainly that's going to impact the normal associate valuation transition as well as the private equity space. we'll talk about how those two differ and how it would impact, obviously, your financial plan if you made one of those decisions to go down this road and sell. In the end, you're going to sell this to somebody. It's an asset, so we got to sell it to somebody. I just know that obviously, here's some of the numbers that you're giving up. You can save, over $100,000 a year right now in pension planning. So if you had a practice that was doing 2 million and made $1 million, I mean, obviously, you're getting absolutely crushed in taxes. And again, tax planning, pension planning is key. As an owner, you're giving all those things up. So just making sure, again, you understand what you're giving up out of this deal. Taxes are obviously going to be very real. If you do end up selling the business one day down the road, you're going to want to know how to play the overall tax game. This slide here is super important. These are 5 places that you are going to have your total investments. Number 1 is your corporate S corp. That's the business you own. So that's where you're owning the practice. If it was a $2 million business that did 50% overhead and made $1 million, that's the entity that you're tax planning from. And then what you're basically doing is moving money up to the tax deferred environment. So you don't pay taxes, you're running things through your business. Then eventually you're bringing money home to your personal environment. And then you're investing in real estate. And then you've made decisions to invest in tax free. The reason these 5 circles are important is because you have this asset, in this case, the dental practice, and what are you going to do with it? And so, because at some point you can't practice a new dentistry anymore. So there needs to just be this kind of formal plan of, well, what is it worth? So we have a value here and it's going to impact your plan. So I want to discuss that, here in a couple of seconds. So this is what I don't like. Here is an example of a profit loss statement that just is extremely common, and there's just no action plan. Okay. So you've got kind of this example of this $1.2 million collections at the top. We've got payroll expenses. I don't know if that's the doctor. That's, if that's, could be a GP practice. There's nothing that will tell me anything about what type of practice this is, because it just has some generic labeling across the board. So this doesn't tell me my EBITDA. This doesn't tell me key indicators. This doesn't help me with any type of strategy. This is basically a doctor keying information in, or basically, an accountant that is grabbing information, putting it in some type of generic chart of accounts that they came up with and presenting something back to the doctor. And there's just really no action items, out of this. And so what you're looking for, for example, in an orthodontic practice, you want to have actual goals inside each of these indicators. So I'd want to see, top line revenue. I'd want to see production, collections, then call it 2.1 or 2.2 in my production. I want to be able to see, now I've got 2 million of collections. I want to see my team cost. I want to see it broken down, from assistants, could be from TC to marketing, financial coordinators. I want to have that broken out. So now I can see and have a measuring stick. And this 17% goal that we're looking for, and we target out of our 700 orthodontic practices, is actual their salary and payroll tax only. So if you're giving them a 3% on their 401k plan, safe harbor, if you're paying any type of health insurance benefit to them, I want that actually separated out. And I can actually see now your true maybe team, goal or team cost is maybe at 20%. But the part I want to measure always is going to be just my what it costs to employ them and my payroll taxes only. That way I'm benchmarking that exact same thing against the other practices, because you can have one practice that gives no benefits and another practice that gives 5 or 6 or 7% because they've got a profit sharing and cash balance plan. They're paying 100% insurance. They're doing some type of allowance for CE, things like that. And so that's quite okay. But again, it's just something I want to have a separate line item for that. I want to see our true dental supplies. I want to see our orthodontic supplies. I want to know if I've got, number of cases I'm doing. I want to be able to see my true aligner cases, or if I've got, some type of bracket system that, is marketed towards bring up your chair time. I need to see why these costs are higher, in this case in supply or lab, because if I'm high on my supply and high on my lab, that better result in a higher return on investment. In other words, I'm getting lower team costs. So if I can look at all of these and say, hey, I've got 17% team and 6-7% supplies and 6-7% of my lab costs, great. So it's a balance thing of just making sure that we're on track. So it's important to manage this, because again, we're running these, our average practice does, over $2 million. So just these small little things that we can do to set, realistic goals between the doctor and the team, to hit some of these goals, it just allows for, more cash flow for the practice, and allows the doctor to be more generous with benefits, and just to understand again what their value and what their EBITDA is, because many of our orthodontic clients really want to know what their EBITDA is at all times. When you have really nice, clean financial statements like that, it allows you to make really cool and quick decisions. For example, if I was going to be bringing on an associate and I was paying them, call it $1,300-1,400 a day, I figured out they're going to work 3 to 4 days a week. I can calculate what their compensation is. I can calculate if I need to bring a full-time assistant in. I can calculate if I'm going to go from a 5-chair practice to a 7-chair practice, and I'm going to expand and have capital costs. I can quickly dial into my financials and look at my current supplies, current lab, office supplies, and actually come up with what my true direct costs are. It allows you, by having good information like this, working with your CPA, to actually run a break-even analysis on these types of decisions. So in this particular case, I've actually calculated what the break-even would be just to make the decision, should I bring an associate in or not? And this is saying that my collections would need to cross over $238,000 based on just these little 3 simple facts. Maybe I don't need the capital improvement because I have the chairs. Maybe I'm already overstaffed, with assistants. Maybe I'm already booked out. Maybe, some of those things like that. Maybe the orthodontist you're bringing in happens to be married to a pediatric dentist and they weren't referring to you. Whatever these cases are, that's what you want to have, all the information, and then be able to take this data, again, from nice, clean financial statements, and then run break-even costs. You could do the same for, a building. You could do the same for, any financial decision that you're trying to make. You basically are extrapolating your direct cost and figuring out what this new kind of fixed cost thing is going to be, and then running a break-even on it. So, okay. Let's take a look at the value of your business. So the first thing we're going to do is look at this particular practice, and we are going to look at it and come up with what is the value of this thing, and what else does this practice actually tell us. So the first thing, I've got a production of 1.3 million, so it's growing. So just always remember that, high production. If the production is higher than collections, I want to see that from a valuation perspective, because I know that the value is actually going to be worth more. If I see a production that's 1.1, and I see a collections of 1.2, that tells me actually the practice is dying to some degree. There's questions I should be asking. I've got, you want to be able to see starts, and you want to be able to see contracts, and you want to be able to see, total production. And there's a lot of moving parts in an orthodontic practice as it pertains to valuations, and certain things that are standard in our industry that you really want to know. It's not just the GP that does, 1 million and collects 1 million. Like, okay, we'll take a look at hygiene, take a look at these other things, but there's so many just moving levers on the orthodontic practice. And from a valuation standpoint, it's actually quite interesting, and not that hard because we do hundreds of them a year. But it's something I certainly want you to be aware of and be thoughtful of. So in this case, I like the collections at 1.2 million. The production I like because it's higher. It's got a decent overhead. 55%. So I'm happy there. I've got a business that's making $540,000. Expectation with this doctor is that 90% of collections is quote unquote the price. So I've got no problem with any of this. Functioning equipment's nothing great. I don't have brand new, tariff scanners. I don't have brand new this or that. Doctor's going to be willing to stay. That's a smaller chair practice. It's a 4-chair practice, 1,400 square feet. Doctor's 60. It's been stable. This is not a private equity practice. This is not something that, well, I got this letter from, Smile Doctors, and I think they're really interested, or SOP or Bond or whoever. This is not that practice. Okay. This is going to be just your traditional private practice sale. That's going to make sense for both the doctor and the buyer. So this is what I'm seeing here. Okay. Take a look at number two. Number two, production 1.6 million, and I've got collections 1.7 million. This tells me this practice is actually stable. So it's consistent, that it's not growing. It's a 1.7 million practice that's pretty much kind of flattened out. Overhead is really high at 62%. So this is something that, really trying to figure out what's going on, to try to dive into some of those key metrics. This particular guy is actually wanting to bring in an associate. And so it got me to a lot of questions with him to ask him what was truly going on. And bottom line is, hey, if your overhead is at 62% and you're making about 640, are you sure that you can afford somebody? Okay. And yeah, I like the fact you've got nice space. I like the fact it's finished out. And I like the fact that you're saying that, you want more time. But you're spending, a lot of money in marketing. And can you afford this? It's just a financial planning question. This is, hey, I got 4 kids. Are you sure that you're in a position to take a pay cut? And this is the hard line questions I'm having with this particular doctor, and to challenge him. So this thing can go 2 ways. He could say, I'm married to a female surgeon and she makes, $1 million a year. And so, yeah, I can afford it. Okay. And perfect. Okay. Well, let's bring in an associate and let's figure out how we're going to grow this thing, or you're going to have to be comfortable with literally just taking a pay cut, because, we need to now start to measure this marketing dollars and figure out why this practice isn't growing. So that's some of the questions I would go through in a scenario like this. Again, this particular practice, the EBITDA, the profitability of the practice is not screaming, hey, let's go sell this thing to a private equity group. If you're looking for a high valuation out of this, it's not going to, even though you have this 1.7 million practice that has a high overhead, it's going to be very hard to justify kind of this new norm, 100% of collections that you would expect. So a couple of things I just said there. This last slide, the 1.2 million practice, what I think it's probably worth, I think it's worth probably 1.1 million, 1.2 million all day. If I was representing a buyer, absolutely, I would say this is, this is a good practice. Representing the seller, hey, what do you think my practice is worth? Based on this data, I 1.1 million, 1.2 million all day. This one here, I need to dive into a little bit more. I need to know how old this equipment is. It's newer. I need to figure out if this overhead truly is at 62% or not, and to really dive in. But let's just say it was, because, the building maybe, was leased out. Maybe it's 4,000 square feet. Maybe it's too much. And it's just killing, his overhead. All right, maybe it's only worth 1.3 million or so, 1.4 million. Okay, it's not maybe the 100%. It's just it's going to eat up the cash. If I go borrow 1.7 million, I have to pay debt on that. It's just going to eat the cash for this particular practice, or in this case, for a buyer who would buy this practice. Okay, now this practice gets a little more interesting. So this is when we're going to first start talking about EBITDA and first start talking about how to calculate it. and then we're going to do a scenario together that we understand it, and then go over how some of the how it works just basically in the orthodontic space. Even I'll do an example of valuations in GP. We'll talk about some of the actual players that are in the market. And I just thought it's important to understand just the valuation of your business, and to understand there's just two separate valuations that are done. One is I'm going to sell to a private practice owner, period, in the story. I'm going to sell to private equity, period, in the story. What most people want is a combination, and you just can't have the two because they're not related. It's either one to a private buyer, and you just need to get around that's what you're going to do, and you have to get rid of this massive number that maybe has been tossed out there, or just accept the fact that it's a big number and the consequences or the risks with partnering with somebody like that, you don't want to do. But if you want that number, that's what you're going to have to do to get that number. So in this case, it's a $3.2 million practice. It's got a great overhead at 48%. So basically the thing nets like $1.6 million. So we need to just high level, what's the value of it? I just would sell to an associate. What would be the value of it if we sold to private equity group? Seller's like, hey, I got this offer like 10 million bucks, but I talked to them, and I don't know if it's the fit. I just don't know that I want to do that. I'm still thinking, like, how is this going to work if I just sold it to a private practice, associate? Maybe I stretch it out over a period of time. I'm 50. I want to do this for like 10 years. I'm telling you right now, it's a financial planning decision. You've got to run this math out. Does this make sense? Okay. So what do I think this thing is worth? I think this is worth $3.2 million all day to my private practice. Here's the keys, walk away. Um, Valuation today on a $3.2 million practice, I'm going to value it, and then I'm going to sell to my associate, maybe sell them 25% or something. I think this would bring a $3 million valuation all day. Now, here's how we're going to calculate the EBITDA. So the EBITDA, I just want you to think of it as the profit before I pay the doctor. And EBITDA is just a fancy, accounting acronym that just basically stands for your earnings before interest, taxes, depreciation, and amortization. Think of it this way. How much does the business make before I get paid or any benefits? So my interest deductions, any depreciation, any perks. Definitely want my orthodontist running through, with them and their spouse, 2 cars, all of their travel, kids on the payroll, 4K profit sharing plans, retreats. When you make that kind of money, you definitely want to be as aggressive as possible, have an aggressive stance in your tax planning. Again, talked about the benefits of being an owner and kind of tax planning along the way, because again, this is how to build wealth over, X amount of years. If the guy tells me or gal tells me she's got like a 10-year run, kind of need to figure out, what am I going to give up if I were to sell to private equity? What do I get if I sell to private equity? What do I give up if I sell to the associate? But what do I end up making? So the EBITDA right now is 1.6 million before I pay a doctor to work back. So in this case, we're going to pay an orthodontist typically a $1,500 per diem. A general rule is that in these large orthodontic practices, that an orthodontist, typically they can see this one doctor, maybe, working the vast majority of this. In this case, I got an associate that's only working 1 day a week at $1,200. I can literally calculate and say, hey, I'll pay you $300,000 to work back. I'll keep paying this associate, something like 50, 60 grand. So now I'm going to essentially pay 300 and call it $50,000 of salary. So my EBITDA goes from 1.6 down to about 1.3. Okay, 360,000 had to go and pay the doctors to do the work. So EBITDA is 1.6. After I pay my doctors, is the EBITDA that everyone talks about. when it comes to valuations. And so this example, I'm about $1.3 million. So if you take $1.3 million, multiply that thing out by 7, 8, you're going to get around this $10 million value. Absolutely. I can see how, and I believe that is the case of what this practice would bring. So I've got two different extremes. I can sell it to my associate, have them buy in, or I can sell it to a PE group for 10 million bucks. So it's a big difference between 3 and 10. So let's talk about how this actually works, and then go through just questions about anything that we talked about tonight. So first thing you want to know is there is a true enterprise value. So that's essentially there's going to be a value, and then they're going to give you X amount of cash up front at close, and then they're going to now have you be a partner with them, and there's going to be some type of equity that they give you. This is part of this calculation. Okay. So the true enterprise value is what we're really searching for. Mistakes that I can tell you that people make is not having your financial planner completely guiding you through this process, your CPA, a broker to negotiate this deal for you, somebody who's obviously has gone down this road before and can negotiate on your behalf, and having an experienced attorney that has gone through this transaction at least a dozen times. This is extremely complicated. You're dealing with some very, probably the most intelligent group of lawyers that's ever been assembled to work for them. And you need to be really careful with all these back and forth of these legal documents, because it is common to see a lot of last minute changes in these documents that don't get, properly, disclosed. You don't quite understand something, your attorney doesn't. You want a dental specific attorney that has done this type of transaction and even knows this particular purchaser, the investor in this case, has dealt with them. They know their team. So super important that you put that right team in place. So super simple calculation here. This is a 2.3 production orthodontic practice that does $2 million collections. Again, I like it because it's producing more. It's got the EBITDA of $1 million before I pay the doctor. $300,000 is easy work back that I would pay for this practice. So the EBITDA after the doctor is $700,000. You're typically going to see somewhere around the 8 is the new great high number that you're going to see today. Okay. Just 6 months ago, we were seeing 9 multipliers. In this case, my EBITDA is at, 700,000. How many times, what X are you going to get? What multiplier you're going to get? And that's what you hear people talking about. Johnny got an 8X. Billy got a 9X. Sarah got a 10X. That's all they recapped at 12X, 13X. MB2 is going to recap at this. Smile Doctors is going to do this. It's all of this just noise that's constant and making you feel like, hey, this is a once in a lifetime opportunity. How is this going to work? Maybe I should sell. They're going to recap and I'm going to be missing out. Here's what's happening. Roughly, to just set us up, 7 to 8 times from a multiplier standpoint is real today. It's much lower than it was just the last 6 months. And just simply because it costs to borrow money. It costs, the interest rates are much higher today. So it costs the investors money to go out and borrow, money for these types of deals, or they're giving up some type of return there. So that's why it's just simply why you're going to see they're being much more, much pickier today than they were just literally 6, 7 months ago. Different types of groups that you can partner with. One is just a simple, I'm going to give you 70% up front, and you're going to be have some type of equity in the investor. In this case, you can pick any company. One case could be, hey, not only we're going to give you 50, 60, 70%, cash up front, we actually want you to retain and be an owner, of the business. And then maybe want you to participate in some type of DSO as well. Some may be 70% cash up front, and you're just going to be 30%, owner of the practice. And here's how we're going to split money with you. And, here's what we're going to try to sell, in the future. So there's different types of models that are out there. You definitely want to make sure you understand who you're partnering with and how it's going to work. Okay, so let's go through this calculation real quickly. We had a 700,000 EBITDA. I'm going to assume at 8. And so we have an enterprise value of 5.6 million. We're going to assume a very standard 70% of that's going to be cash at close. And so you're going to get $4 million up front. They're going to have a very stringent work back agreement. And so what you're going to have to do now is work back for them this 300,000. Probably going to be some earnouts, some minimums you got to hit. And so you keep making 300 grand. And then, the idea is somewhere around year 3, 4, 5, you get a chance to maybe recapitalize with them, and you're going to get some type of 9, 10, 11, 12x. And so I was very generous in this example, and I gave you a 12x. I give you the best case scenario. You sell the 70% up front, so the last 30% at year 5 at a 12x, and you financial planning one-on-one, you take the money, pay the tax, invest it, make less money for the next 3, 4, 5 years. Boom, you get a bunch of money up front. You get to pay taxes on that, and invest that. There's some type of number. Okay, for simplicity, I just kept this the same and just basically said all 4 million. Don't worry about taxes, income on the 300. I didn't think about, and then on the right, I kept your salary basically $1 million, a year, which is basically the 50% you're making. And then we total all that up, and you sell 100% of collections. You take a $2 million practice and sell 100%, you $2 million, right? So the numbers aren't that far off. And so in this case, you might make the case that, maybe you do sell to a private equity group in this case, because the one on the left is bigger than the right. It's just, you're gambling a little bit, with it, and you're more in control when you sell to a private practice. I'm not in any way trying to steer you to do one or the other or have a hidden agenda here tonight. I'm just simply telling you that 3,000 dentists that we work with come to this with these kind of scenarios, and we have to be able to guide them what the right decision is, because it's obviously a very important one. So again, financial planning will tell you the answer to each of these. I'll quickly go through this. Super quick on the GP side, because I think it's kind of something important for you to understand too. They're not quite as lucrative. Okay, so here's a $2 million practice, same 55% overhead, and we actually have to look into the doctor restorative work and their hygiene. Same overhead though, same $2 million practice. And what we find out is we come up with an EBITDA of 900,000 before we pay the general doctor their compensation, because I got to pay them a lot more. So now all of a sudden, I'm not going to pay them 300,000. I'll pay them anywhere between 500,000 to 600,000, because I got to pay them 35% of their restorative work. So in this example, my EBITDA went from a $700,000 number all the way down to 400, or even down to 330. My multiple is not an 8, it's at a 7. So now my enterprise value is maybe 2.823, whereas in the orthodontic practice, it was a 5.6 number. So it's a huge difference. So this is really, when you look at these, you'll see some of these big numbers really can sometimes really make sense on the orthodontic side. That's really why you see so many orthodontists have done this. Now again, I'm not saying what to do. I'm just kind of showing you what the math is, and you make your own decisions. So I ran the case out for this, and keep working, maybe bring an associate in, who knows. But these numbers are very similar. So I run the numbers out, stay, sell, higher EBITDA, calculate it out, like what's the best case scenario. We sell this thing 3, 4, 5 years. get the cash up front? What does it look like? Or just remain the doctor? Because you're gonna have to remain the doctor, right? There is no, you know, I'm going to get this $10 million thing up front and then you don't have to be there. No, it's not how it works. You're going to have to stay there. And again, you will significantly take a pay cut. You're going to go from the orthodontic example, going from $1 million a year, 300 grand. My experience is people who make $1 million, spend a lot of money, they go down to 300,000, they're going to take a huge pay cut, and they're probably going to be dipping into their savings just to keep their lifestyle up. It's 300 grand again, no tax planning. All my car, all the things I've been running through now, it's all gone. And so now I got to pay tax on 300. I'm down to like 200. There's no efficiency in tax planning. I don't own a business anymore. So you got to really think all this through before you just look at this big, sexy top line number and go, hey, that's what I want to do. Like, this is super complicated. Okay, quick exercise for you. So let's see if you can figure this out together. So if you have a calculator, this is your time to figure out kind of what to do. So this is a big practice, and we can look at this from an orthodontic standpoint. You can look at this as a GP standpoint, periodontist standpoint. Look at all the business because you understand how to do it. So in this case, let's just play around. I'm going to take out the GP example, for example, just for a matter of time. Let's just focus on orthodontics. We know it does 4 million. Do we think that's a very big practice on orthodontic? Absolutely. That's at least, 1 3/4 orthodontist, 1.5 orthodontist for sure. That's a big practice. It's a busy one. I'm not saying I don't have orthodontists that can't do that, but let's just call it 1.5 orthodontists. So it's got a 52% overhead. So then basically, what you're doing is saying, well, how much does this thing make? So at $4 million, times 0.52%, it nets 2 million. Well, it's got 40, sorry, just the example. So nets 1.92 million. So 52% overhead. So I need to pay back my orthodontist to work in the practice. So how much I'm going to pay my orthodontist? Well, I'll pay them 300,000 for, and I'll pay them another 150,000. So I'm going to get about 6, call it orthodontic days, a week out of that. I think that's enough to cover that $3 million practice. So in that case, I would start with $1.9 million as my EBITDA before I paid my doctors. And then I would minus my associates, which we said was 300 plus 150, so minus 450. So now I have an EBITDA of 1.45 million. I'm going to give this a nice 8 number. So I'm going to have probably a $11 to $12 million valuation on this business. And I would do the same thing if I calculated it for a GP. I would look at who the associates are. I'd look at the restorative work and try to figure out, does this make sense for, in this case, that doctor? For a GP, probably does, because it's going to be very difficult for them to sell that practice, to an associate, because you're going to be 2 associates do GP. The one orthodontic practice is going to be difficult for them to sell as well because the valuation is going to be $4 million. And so if they try to sell that just to one person, the buyer can't get the loan. So you come across these challenges with each individual circumstance. Here, general rule, large, giant, big practices, those are the ones that typically make more sense to probably sell to private equity because they're easier to basically pull the equity out. So we talked about the importance of growing your business. We talked about the importance of with growth of your business, growing your financial plan. With financial plan, by growing that, utilization of your practice, utilization of the asset, the dental practice, eventually pulling the equity out. It gives you the financial freedom and time. With all of this, helps you understand, what the opportunity is to bring an associate in, the reminder of the benefits of being the business owner, running things through the business, tax planning wise, taking advantage of your pension plan along the way, knowing those kind of 5 key environments and understanding how the sell of that business will impact those environments to play the game on distribution planning one day when you're ready to retire. Good financial statements will help you with good break-even decisions, both at your home as well as the business. We talked about different valuation models, just as a private practice owner, as well as the corporate on a PE route. And we learned even how to calculate our EBITDA. So that's what we learned. Cain Watters, again, if you need, I'm happy to share this into a PDF format with anybody. I'm happy to look at your financial statements and tell you what I think your value of your business is, or tell you what tax planning I think that you're missing. Just simply the info at Cain Watters. You go to the Cain Watters site. NDP is the transition department that does valuation work. Seven Pillars is the company we utilize that actually, when a client does want to go to a private equity, that's the company that will broker and negotiate for you and help you understand what all your legal documents are. That is that entity. And Elite is the largest group purchasing organization that we have. That's the largest group purchasing organization in the country, and it helps you with just all the purchases that you can ever have, including Orthofy is one of our vendors there. So if you need any help on that front, just to reach out and to let us know. Marla, we've got 8 minutes. You told me 7:52, and I'm on it. I'm watching it.
Got it. You did
So
good. You
yeah,
did good.
let's. Do you want to take a look at just any Q&A and or any chats or comments, and let me know what we can do
Sure.
from here?
Yeah, we do have a few questions. So there's a question here. Curious what your opinion is on dental management companies that have little or limited ownership in the practice. Is that a smart alternative to selling to a DSO?
I don't want them to own. No, not at all. No, I mean, I like practice management groups, and I want them to be orthodontic specific. So, I want someone with a proven track record. If it's a Jill Allen that's going to do my startup, I'm going to feed her all day. This is who you're going to go to. If it's any 3, 4 orthodontic, consultants that we work with that have amazing track records. I mean, but they're not going to own anything at all.
Yeah.
No, they do not need to own this at all. The only time you're going to ever partner with somebody is going to be your associate or one of these big groups like the Smile Doctors or SOP or MB2, DCA, Bond. You're going to partner with them to get that high value.
Yeah. So I think that and this may be a mistaken that we're not real sure what's going on, but so I think that there are the DSO OSOs who have full ownership, and then there's also management companies that the doctor really retains the ownership, but they're a management company. So there's that's a different kind of purchase. So I think that that's what this question is referring to.
Yeah. So you're giving up equity, and make no mistake about it, you're going to probably invest in some of the OSO or some of the give you some type of stock in it. You may have like an MB2 model where you're going to actually still be the owner of the business as well, like a certain percent, and allow you to participate in the DSO OSO type, and even have some other like side investments for real estate, and they'll let you participate in some of those pieces. It's one of those things, again, you have to evaluate all of those pieces. For example, when you look at like an MB2 model, like I think they've done amazing. I mean, we've partnered with them, meaning that we have had our clients sell to them, and I think they've done a great job. They had a good reputation. But you do have to understand it, right? Mm-hmm. I mean, I'm going to give you a 7-8 now, and let's say that's 60%. So then I'm going to leave 40% in the company. Then I'm going to hopefully get to sell another 20% at this other higher number. That's the goal. Mm-hmm. And then you're going to hold on to this other 20, but you don't get to sell that last 20 at these higher multiples. Oh, you don't? No, it's got to give you a lower multiple. Wait, are you right? How does that work? So you need to actually estimate or calculate what that is. So you can't take this giant enterprise value and actually ever get all of it. You're just trying to focus on, I know I'm going to be able to get 60 or 70% of this. That's a guarantee. Cash out. Next is I'm gambling on the next one, and I'm gambling on the next one. And I feel really, really good about my partner and all of my other people that are working at this and the success and their liquidity. I've asked all the questions. I've got the right CPA. I've got the right broker. And I've interviewed. And I trust, I think I'm going to do better with them than I would just on my own. That makes sense.
Yeah, I always, every time I listen to you, I think that for a practice to go into this without an advisor, without someone who really knows all the ins and outs of the different types of models, it just seems like their outcome will be a lot less if they aren't getting some advice on some things. So I love all the advice and information that you've given us tonight. One question here: what is the biggest mistake that you see people make when selling their business?
I mean, just doing it without guidance. There's, for example, take a regular private practice sale. If somebody could tell me, hey, they're 60 years old, and say, look, I've got $1.2 million practice that we talked about tonight. What's my value? What do you think it's worth? Hey, I think it's worth $1.2 million. Great. Then I can tell you that, hey, if you give me, a couple of years, we can bring this person in. I could set up a cash balance plan, do a lot of creativity with tax and pension, take the money from the sale and almost pay no taxes on it because I have a window and a plan. Perfect. I get people all the time that, they'll call me up and say, hey, I'm selling to private equity and I just want you to look over the documents, or now I need financial planning. And it's just, can certainly help those people, but it's just painful that they don't understand what they're getting themselves into. And so I mean, the biggest mistake is just it's literally doing it on emotion, not without the emotion, and doing it. I call it just a quick decision, like this is what I'm just going to do, and not asking all the right questions. And I really do think that, I would say mainly men. It's hard. In my experience being this 23 years, it is hard for someone just to go cold turkey and stop and start working for somebody. Women are a lot easier. They're like, hey, you want to take it over, go right ahead, they're willing to partner more on like a private practice, much easier. But you need to be mentally ready for this process too. It's not just, selling it, and that's the kind of the biggest mistake, but mentally ready, financially ready, and have all those key pieces around you and someone to think and pray about it. Just don't rush into these things because somebody is basically, you got the letter from the associate or someone's, doing this or giving you a deadline. That's not how you're going to make a good decision in life.
Right. Yeah. So what about, I'm sure there's a lot of misunderstandings also around valuations. And if you were to kind of peg, one misunderstanding that you'd like to help people avoid, what would you tag that as?
The biggest one is just what I was saying earlier is the whole private equity. My business is worth $4 million. My guy told me, I got a letter, someone, but I don't want to sell them. But I still want that value and I want to sell it to my associate. You just can't do that. Like I deal with that probably once every 2 days talking to somebody. And probably 50% of every client that I speak to, a prospective client, they're calling me about either buying, selling, valuing something. In this case, about their practice as well. So you can't commingle those two. They're two completely separate transactions. Private practice to private buyer is one value. Private practice that's going to sell to a private equity firm, completely separate value, completely separate contingencies that are going to be attached to it. You're not getting it all up front. You're going to get a percent. You're going to buy in, then you're taking a pay cut, and there's going to be a 3 to 5 year commitment, more like 4 to 6 year commitment. That's going to be a part of that. So it's just this misconception of PE is, causing the values to go, crazy, and they're going to take over the whole industry. You've got specialty dental, big giant name, just big giant name. All of a sudden, stop buying practices, laid off their people. So there is potential here that we don't just whole industry just goes, away, and it's all going to be, PE ran. We'll see about that. Every time that there's a sale, it dilutes the original owner's visions. And so, we'll see. I think it's a great space for young dentists. And I just think private practice ownership is your best option to manage and create wealth with the least amount of risk.
Right. Okay. Awesome. If you don't mind stopping sharing your screen for just a minute.
Yeah, for sure.
And I'm going to let Lauren share her screen. And I promised everyone who's here with us tonight to tell you a little bit more about Nexus. So really quickly, a couple things. First of all, if you've been with us tonight and you're not an OrthoFi customer, you can receive $2,000 off your implementation fee if you complete a demo and sign up before October. The first 3 practices that sign up based on this webinar will actually receive 50% off, which is $4,000 value. So make sure you use that QR code if you'd like to see a demo of OrthoFi. We'd love to talk to you about what's new. Even if you saw a demo a while back, make sure you see one again, because a lot's changed and we're really, the pricing model is a little better than what was out the first time. So we'd love to talk to you about that. And then Lauren, the next slide about Nexus. So the dates for Nexus are February 1 through 3, 2024 in Denver again. Use this QR code and use the promo code INSIGHT and you'll receive an extra 5% off. I'm told that takes between 25 to 40-ish off of the ticket price, which currently is early bird. So you're already getting a good deal and you can get better on top of that. We are, I've been working all week on the lineup of the speakers for that and what the program is going to be. So it's really going to be cool. We're excited to share some new topics with the industry this year, and we do hope you'll join us. Thank you again, Charles, for your time tonight. Fascinating. Every time I hear you speak about how the valuations and the transitions go, it's always just really interesting to me to learn, and I know our audience feels the same way. Thank you so much, and we'll see you again on an industry expert webinar very soon. Thank you.
Okay. Thank you so much.